Welcome back, friends. Today we are going to discuss a very important topic in trading, which is CRT, candle range theory. CRT is a trading strategy that helps traders understand market price action and make precise trading decisions. Let's dive into the details of CRT. What is CRT, candle range theory? CRT is a price action-based trading strategy where we analyze the range between the high and low of candlestick charts. This theory suggests that the market operates in a fractal manner, meaning the behavior of the market is similar across all time frames: monthly, weekly, daily, 4-hour, 1-hour, 15-minute, 5-minute, 1-minute, and even seconds, 15-second charts. According to CRT, even a single candle can be traded because each candle has its own range. By understanding this range, we can gauge the market's direction and momentum. Core concept of CRT, power of 3, PO3. The core concept of CRT is the power of 3, PO3, which defines market behavior. According to PO3, every market movement goes through 3 stages: accumulation, consolidation. The market moves sideways as institutional traders, smart money, build their positions. Manipulation. The market is pushed in one direction, either up or down, trapping retail traders. Distribution. Smart money closes their positions, preparing for a market reversal. These 3 stages repeat across all time frames, from 15-second candles to weekly charts. How to use CRT. Identify key levels. The high and low of each candle act as key levels. If the market breaks this key level on any time frame, it is considered hit. Wait for reversal. After a key level is hit, expect a potential market reversal. This can be observed on smaller time frames. Turtle soup entry. When the market breaks a key level and then forms a new low or high, it is called a turtle soup entry. Entering a trade at this point is considered high probability. Setting targets. After taking a trade, the first target should be the equilibrium, midpoint of the candle. The second target should be the candle's high or low. High probability versus low probability entry. High probability entry, when the market trend aligns with your bias, buy or sell. Low probability entry, when the market trend does not support your bias. Example: suppose the daily candle range is 100 rupees, low, to 110 rupees, high. If the market breaks 100 rupees on the 1-hour time frame, the daily candle's key level is considered hit. Now, look for a turtle soup entry on the 15-minute time frame. The first target would be the daily candle's equilibrium, 105 rupees, and the second target would be the daily candle's high, 110 rupees. Benefits of CRT works across all time frames. Helps traders understand the fractal nature of the market, simple and effective as it is purely based on price action. Points to remember in CRT. Wait for confirmation to avoid false breakouts. Understand the overall market trend. Always focus on risk management. CRT, candle range trading. Types and explanation. CRT is a trading strategy that focuses on using the range of specific candles to identify key levels for trading. There are 3 main types of CRT. Single candle CRT. In this type, we focus on one candle and use its range as the basis for trading. If we take a 4-hour candle as our range, we wait for the price to break the high or low of that candle on a smaller time frame, like 5 minutes. Once the price breaks the high or low, we confirm the move on the smaller time frame and enter the trade. Targets. Target 1, the 50% equilibrium level of the candle. Target 2, the high of the candle, if buying. or the low of the candle if selling. The high and low of the selected candle become our key levels for trading. 2 candle CRT. This type is similar to single candle CRT, but here we use 2 candles instead of 1. We take the range of the first candle and wait for the second candle to show a purge, which is a strong move in the buy or sell direction. Once the purge happens, we look for an entry on a smaller time frame. Targets. Target 1. The 50% equilibrium level of the first candle. Target 2. The high of the first candle if buying, or the low of the first candle if selling. 3 candle CRT, inside bar CRT. In this type, we focus on one large candle that contains multiple smaller candles inside it, known as inside bars. The high and low of the large candle become our key levels. The smaller candles inside the range are not considered key levels. When the price reaches the key levels of the large candle, we wait for confirmation on a smaller time frame and enter the trade. This setup is considered a high probability CRT setup. Key points to remember: market. Algorithm. When the market hunts for major liquidity on one side, it often returns to hunt for minor liquidity on the other side. This behavior increases the probability of the CRT setup working. Entry techniques. You can use turtle soup or inversion entry techniques for entering trades. Daily bias. The CRT concept can also help determine the daily market direction for trading. Why CRT is effective. CRT helps traders identify clear key levels and targets based on candle ranges. It simplifies the process of determining daily bias and reduces confusion in trading decisions. This explanation should help traders understand the 3 types of CRT and how to apply them effectively. Which type of CRT do you find most useful? Let me know in the comments.